Hello, everybody.
Hello,
Jerry,
hello.
how you doing?
Pretty
So this
good.
is an interesting day because just looking at a, a post from Gold Telegraph talking about the unrealized losses on investment securities held by banks in the United States stood at $558 billion as of June. And Telegraph wants us to remember that this year we've seen Silvergate Capital, Silicon Valley Bank, Signature Bank, First Republic Bank. They don't mention Credit Suisse, but there was the marriage at Credit Suisse. We'll never know what happened. And
Yeah.
then you found an article this morning that has been quickly developing.
hmm Yeah. Major news around the UK. So this morning we came in and article says from the Guardian, the Metro Bank customers are urged not to take their money out as bosses say they need to raise 600 million pounds to bolster its balance sheets. Their shares plunged actually yesterday, the Thursday. It was looking to raise 600 million. So the article did elaborate though to hopefully soothe investors to say that there was no indication customer deposits could be at risk. So there is no need to make a withdrawal of your funds out of this Metro Bank, which is called a challenger bank in the U.S. They're sort of boutique and they're more specialized than the larger, longer tenured banks.
Yeah. Is it in the
Uh,
US or UK, you said?
in the UK,
Okay.
sorry. So they're saying, that to summarize, that even if the banks fail in the UK, the Brits are able to claim back 85,000 pounds of their money through the FSCS, the Financial Services Compensation Scheme. So there's just cool investors know, don't withdraw your money. Even in the midst of all of the other banking failures, to stay calm.
So over £500 million that they require, and they're having a capital issue. They're telling the investors that there is no issue. Please don't withdraw your money. And if something happens and it does go down, they're basically insured for £85,000.
That's right. That's
Okay,
right.
and then we saw that this morning, and then by this afternoon, it looks like they've got a suitor to provide the money to them, the $600 million, that 600 million pounds, sorry, that they require to bolster their reserves. Has a deal been made?
Doesn't look like it, Jeremy. So they came off the block at MSN.com that Metro Bank shares are rebounding. Reports of a $600 million offer, and now the stock has rebounded after the news. But the Financial Times has commented saying that the Metro Bank acknowledged of the offer, but they have not yet accepted it. The offer from PJT, who contacted them. So the major concern obviously is this, is that the Metro Bank is operating at the edges of its capital requirements set by regulators and are meant to offset mortgage risks and cover unexpected losses or unrealized losses. So we're going to be hearing more and more about this theme of unrealized losses, Jeremy.
I think, yeah, my takeaway is that, when you think about what we saw earlier in the year with Silicon Valley Bank, that we knew that there would be more to come. We've heard from people like Danielle DiMartino Booth, who said that they're going to try to keep these type of issues quiet and masked from the public. So you have to look at what the Federal Reserve's doing and how much they're printing and creating and potentially papering over. But the fact is things are going to bubble up. Things are going to continue to bubble up. And when you're raising interest rates, when you're printing all of this money, um, things are gonna happen, and you're starting to see it. So this is just another example of be on guard because it's not over.
Yeah, and it's crazy that the regulatory bodies are trying to soothe investor worries and sort of build confidence. We are here in Canada, and now right now we're seeing even like it looks like a campaign of from the CDIC, the Canadian Deposit Insurance Corporation, giving us commercials like 30-second clips talking about how CDIC will protect deposits in the rare event of bank failures. I don't think it's as rare as it once was.
I just, it is counterintuitive. We started to see those stickers at banks pop up several years ago, that everything was insured. And then when they're posting ads about it, you kind of, it's one of those things. I didn't know there was a problem. You're alerting me to the problem, and you're telling me that I'm insured when the problem finally hits. It's just
Right.
kind of like, why bring it up? Why
Yeah.
bring it up? But they are bringing it up. And so pay attention. They're telling you that you're insured if there's going to be a banking crisis.
Mhm.
So be prepared for a banking crisis. How else could you read that?
Exactly. That's the way I read it. I mean, it's we're seeing a theme of bank failures. So this is obviously a campaign, in my opinion, of trying to quell concerns. And just this week, and almost on time and on cue, Peter Schiff wrote a really good article. It was written by Tyler Durden, who commented on what Peter Schiff was talking about. The Peter Schiff had a headline saying banks have a bigger real estate problem today than it did in 2007. So this challenger bank, Metro, is a lender. So they deal primarily in mortgages, they lend, so they need to have capital reserves. And Peter Schiff reminds us, 2007, 2008 crisis, the problem was defaults. Interest rate rose, people couldn't afford to pay their mortgages, banks foreclosed, and with the real estate bubble deflating, banks couldn't recoup their loans by selling houses. And he writes, the problem was that banks had loaned out a lot of money with zero down, house prices dropped, people started defaulting, and then because of the defaults, the banks just lost money. But the vast majority of mortgages, they didn't default. It was a large enough percentage, though, and it caused insolvency at the bank. And because we have a fraction of reserve system, Tyler writes, banks don't have nearly enough reserves to cover even a small number of their loans. But today, fast forward to 2023, we have a much different problem. And this is what we're talking about, unrealized losses. Peter Schiff wrote, it's a lot worse. It's not about a default now. In fact, defaults would actually help the banking situation. The banks would actually be better off if people defaulted on mortgages and get them off the hook. The problem is the mortgage package itself. The banks are losing money on the mortgage because remember, banks wrote these mortgage when interest rates were really, really low. A 3% mortgage wasn't uncommon a few years ago, he writes, but now mortgage rates are 7%. The banks are losing money on every mortgage that's outstanding. So even though people are still paying their mortgages, the bank is losing. So that's the definition of why we're seeing that's the cause of these unrealized losses. And it's a bigger problem for the banks, especially when depositors take their money out. They need those capital requirements. They need the money in the system in order to remain solvent, Jeremy. It's a wild time. It's a really wild time.
Yeah, and I'll take the mortgage issues, and I'll raise you that when interest rates were at zero, you had investors or savers were forced to chase yield.
Right.
Well, now that inflation is, they're saying it's at, I mean, inflation's above 10% on a lot of things. Maybe it's deflating in real estate, but nonetheless, you have inflation much, much higher than 5%, but you're only getting 5% yield. So you're still having to chase yield. Only this time you're chasing yield when every single company is dealing with higher rates. There's going to be loans that roll over. You have people who can't afford to go out and buy, shoes and technology and all of these things because they're paying for their basics,
Right.
right? So, and then of course you've got employees asking for more money. You've got higher cost of energy. You've got costs going up across the board, whether it's your insurance or your shipping prices. Everything's getting more expensive. Margins are shrinking. So you're chasing yield in this environment, and the banks are telling you don't panic. It's one of these things where it's like where you're sitting there thinking, well, maybe I shouldn't have more than the insurable amount. And do I want to just be safe with, well, it's insured? Do you want to chase after that money if if something does happen to that bank? So the idea here is to undigitize the wealth, become your own central bank, have your own physical gold and silver on hand that doesn't have counterparty risk, and you'll have the liquidity. I personally don't like the idea of, well, I may have to go chase after the insurance claim.
Right.
So that's
Oh,
my thought.
100%. And then
Yeah.
this is the reason why we have to be the beautiful thing about precious metals and have a reserve outside of these systems is the fractional reserve system is just that. You want to create a reserve that is decoupled from these risks, that is decoupled from financial institutions, leverage, bank failures, currency devaluation. Back to real estate, it was at a point where it was real estate that was outperforming. But when everything else is moving up with it, this is a symptom of not just property values going up anymore. And when everything's moving up, that's a bigger problem. When you see coffee, when you see the vegetables going up, when you see goods and services and wages not keeping up, this is a bad stagflationary risk.
Yeah. Do you see
And
orange juice? Orange juice is up something
OJ,
like 1000%, something like that. Crazy number.
yeah, it's wild. So, precious metals protects and provides insulation from these various risks. I mean, the risks are multifaceted, Jeremy. This is well beyond 2007, 2008, and we need to be prepared. And those who have precious metals are, and if you're not, it's definitely time.
Yeah. Well, we'll be watching, and we got to get ready for our radio show.
Let's do it.
All right. See you all later.
See ya.